due diligence takes effort. I fly all around the world, and I literally go underground. This is Colombia. They all had these huge machetes, and I wasn't sure what was going to happen there. And that's where the speculator can really benefit. When you see a separation, a distinction between price and value that the investment herd doesn't see.
Hi, everyone, and welcome back to another episode of Trading Takes. And we have a special edition today. We have Stan joining us for a fascinating conversation with Lobo Tiggre. And he is a natural resource speculator that is dealing in the commodities business. And it's a very unique style, and actually one that I started off my career in, and then I branched out into other styles. And now I use as many as I can for my overall trading. But Stan, thank you for joining me today.
Yeah, absolutely, Chris. Thank you. Thank you for having me, and I'm looking forward to the conversation with Lobo.
Yeah, and then let's bring on our guest, Lobo Tiggre. Lobo, welcome to the show. We appreciate you coming on.
Yeah, thank you for having me here. And by the way, Stan, if I say something that seems actually boneheaded to a more mainstream perspective, please push back. I'm not the all-knowing guru here. The idea is to try to be helpful and hopefully not bamboozle anybody in the audience.
Oh, yeah, absolutely. No, looking forward to it, Lobo. Yeah, no worries.
Definitely, and that's kind of what this the point of this conversation today was, to be able to bridge different trading styles or different investing styles. And we're backed by Investors Underground, and that is a large community of more traditional traders, day traders, options traders. We have swing traders, but much more of like the traditional financial traders. And then kind of on the total other end, you would have like very long term like investors or maybe passive investing, and then somewhere in the middle there's speculating and natural resource investing, which kind of is a combination of fundamental analysis along with cyclical investing, understanding, some technical, some macro. And so it's really a very blended style. And I think what it would be great to do today is to really just talk about what are the similarities, what are the differences. But before we get into that, Lobo, I would just like you to take a second to really catch people up on who you are, what your career has been, and how did you get into natural resource speculating?
Sure. And perhaps, it helps. I love this conversation in concept anyway. We'll see how it goes. But I do these interviews, and I most often ask, well, where do you think interest rates are going? What's the Fed going to do? What's the price of gold going to be at the end of the year? And I understand why people ask those questions, but my career, my work has been, I'm a due diligence guy. 20 years ago, Doug Casey and David Galland founded Casey Research, and they needed a writer actually to help them with editing the periodicals. And that's where I came in. I didn't know anything about geology. Well, I studied it informally, but I don't have a degree in geology. I had never bought a stock, didn't know what a warrant was, but I loved it. It was so interesting to travel around the world and look at the rocks and talk to the geologists and have them explain to you what they're doing, and then talk to the financial guys and see how they can direct the invisible hand of Adam Smith's invisible hand of the market to the most remote corners of the world and create value and enrich the locals and provide the raw materials that our civilization depends on. Like, the whole thing was just fascinating. And I guess I have an analytical bent, so it didn't take long for me to learn things. But I'm much more comfortable talking about due diligence, understanding companies, looking for pitfalls and red flags, stock selection, stock strategies, investing, speculating, than I am, where's interest rates going?
Yeah, absolutely. And so,
sorry, just to wrap up the story. So 20 years ago, Doug and David hired me. I learned a bit along the way. I have now traveled to 66 countries, kicking rocks on behalf of readers. In 2018, I went out on my own and founded the Independent Speculator, which was homage to Doug Casey's International Speculator. And I did ask him first, by the way. He gave me his blessing. And so, now I apply what I've learned on behalf of my clients. And again, my main claim to fame is not as a crystal ball seer of, where the future is going, but as a due diligence guy.
Yeah. And so, how would you kind of define speculating in your own terms? Because from my perspective, and when I was explaining it to Stan, I was saying that it's basically people who are looking at a very broad macro landscape, and they're looking at different commodities. They're looking at supply and demand fundamentals. They're looking at macro inputs, and then they're saying, okay, if I'm bullish on a particular commodity, then I want to go into the sector and look at how could I possibly play something that is related to the sector. And that could be with producing companies like a copper producer. It could be with development companies, someone who has a deposit, or it could be an exploration company, someone who's looking for a deposit. But it's basically these different companies are involved with a commodity. And if you're bullish on a commodity and if you have a great company, then that's basically the process of what a speculator is trying to do. And if they get the commodity right, they get the company right, then they can have some great rewards. Is that how you would characterize it, or how do you go about it?
It's a special case. I mean, you're framing it in the context of mineral exploration and exploitation, and it certainly does apply there. But I'd say that the same thing works in the biotech area, a number of other areas, where if you know something about it, like I don't know anything about biotech, so I can't tell you which CRISPR company is going to have the next patent that's going to take the company 10x or whatever. But if they do that, it's sort of like discovering a huge gold deposit or something, and getting your permits and so on is sort of like getting FDA approval, or there are some parallels there. So it's speculation is not just about the resource sector. That's one application of it. The sort of textbook definition is that investment is deploying capital for expected return, and of course, a meteor can fall and destroy your investment. But basically, if you build a shoe factory, you know what the market is, how many people there are and how many feet they have and what the demand for shoes is going to be and what the competitors are. You can deploy capital with a reasonable expectation of return. And the bankers can feel comfortable lending you money on this sort of business. That's investing. A speculator is deploying capital for hypothetical return. Like the thing hasn't actually happened yet. And you have a reason for thinking it will or it may, like a discovery. If you're betting on an early stage exploration play, and this team has discovered 5 deposits before, and they have all the surface indications that this one looks like it could be a great, new discovery, it hasn't actually happened yet. Mother Nature loves to torture geologists and put lots of exciting little surface samples all over the place that turn out to be no deposit at all. So it is speculative. Or more broadly, going back to Doug Casey, my mentor, he famously says that the governments of the world can be relied upon to do the wrong thing. They haven't done it yet, but you just know it's a government, they're going to do the wrong thing. So a speculator can position themselves with this large money net to where, the chips will fall when the government does the wrong thing. Like something bad happens, like a pandemic lockdown, what would be the right thing to do? I'm not sure. I'm an expert on pandemics, but economically, you tighten your belt, you soldier on. Like they called it a war economy. Well, what do you do in a war economy? You save, you scrimp, you focus on beating the enemy. What do we do this time? Inflation, right? We sent everybody stimmy checks. It was a classic Doug Casey case of you could count on the government's doing the wrong thing. It was no fault of the people's own. So we sent them all thousands and thousands of dollars. And guess what? Nobody could have seen inflation coming, and yet there it was. So a speculator could have looked at that and said, well, you know what? This is going to be inflationary. And you could have positioned yourself accordingly. You could have bought the companies, the mining companies that would produce hard assets, gold, that sort of thing, or other things. Anything real does well in an inflationary environment. So the real distinction between, in my mind, speculation and investing is it's not just the level of risk, but it's the approach of studying something, trying to understand it, betting that you have a sense of where things are going and position yourself ahead of that actually happening. So there is an element of forecast and prediction here. Whereas investment, it's here's this business, here's now, the ideal investment in many ways is just a bond, right? You buy the bond, you know that it's a It's got a $100 strike. You bought it for 95. You know that it's a 5% return. There's no question there, unless they default on the bond, but that's rare. But you understand what I'm saying? Like you know what you're doing. You know what you're getting. It's not entirely risk free, but as close to as it gets in the investment world. Whereas speculation, you're betting yourself against the market, and that's kind of the fun of it. When you get it right, when the investment herd is wrong. And by the way, sorry, one more quick point here. I'm a big skeptic of the efficient market hypothesis. I do get the wisdom of crowds. There is, the market is a mechanism that collects information. I get all that. But anybody who's actually gotten out of the ivory tower and participated in the marketplace knows that they always get overbought, oversold. Markets are very emotional. People stampede in and out of things. And it's create huge divergences between price and value. And that's where the speculator can really benefit. When you see a separation, a distinction between price and value that the investment herd doesn't see or isn't willing to see, there's great opportunity there.
Absolutely. And that was a great definition of both speculating and investing. And then over to Stan, because you are more of a traditional trader, how would you kind of define, trading? And that's kind of like what a fundamentalist or someone who's looking at like the key variables of a business, they're using that to guide them. Someone who's a more short-term trader might be looking at things like the technicals, like the volume, like short-term market cycles, news, and things like that to really guide them and base your strategy off of that. But either like any of the styles, it's really all based off of risk, reward, and then what's the probability of it happening. So Stan, could you just talk about how you see trading?
Yeah, absolutely, Chris. And I mean, great point there, Lobo, and thank you for the explanation. And for me, trading essentially, the way I view it is I'm just a risk manager, right? I have my chips for the day, and I have my knowledge around technical analysis, around fundamental analysis, around tape reading, and everything else that goes within the trade, and then essentially I just take my chips and I place them versus a reasonable, favorable risk to reward type of ratio. So is there some speculation involved? Absolutely. As we know, just like in the market at any moment, you can get hit with a PR, a headline out of left field, and something happens and it reverses, regardless of what your time frame is or was. But ultimately, it's a shorter term, it's a more so immediate resolution type of approach to trading, I think. Whereas on the speculatory side, I think there's that build, there's that time. It's not necessarily, not that you cannot drill down the time frame and truly find some tremendously skewed opportunities, and I'd even reckon that the smaller the time frame, sometimes the more exponential the opportunity is, just due to the being first in front of the herd. But ultimately, my trading is around more so being a risk manager and just having my chips for the day and allocating them according to each opportunity that I see, with the expectation of somewhat immediate resolution, right? A few minutes, a few hours, etc.
Now, Lobo, kind of hearing that and looking at different time frames, a lot of times when I'm following people like you or other speculators or somewhat people who take fundamentals into account, a lot of times you're looking at a multi-month kind of cycle, and then also periods within that cycle where you might have dips. So for instance, you were last year a very strong uranium bull, and you had the fundamental case for why you think uranium is going to go up. It went up, but then once it started to get a little bit hyped up and everything, you had a multi-month pullback that you were kind of counting on. And so even though like within a very broad time frame, over a year, 2 years, 5 years, you might be very bullish on something, you also change your attitude based on maybe shorter time frames, like multi-month cycles of consolidation and correction before a longer term bullish thesis kind of takes place. So how low does your time frame go? Is it months, weeks, days?
Well, it's not really a time frame. That makes it sound like it's based on this theory or a cyclical theory, and it's not that at all. It's the data. I didn't know when uranium was going to go over $100. I thought it would at some point. I didn't think it would stay there. But so when it pulled a hockey stick, when it doubled in a year, it wasn't a cyclical thing, or it was just, look, this thing has gone way up. It's gone way up above the incentive price needed to bring new production online. Basically, it's hit a level where high prices should start being the cure for high prices. So it was a very reasonable thing to say, some kind of correction is likely here. But boy, did I get a lot of hate for that. But, that was the basis. And I really am not a trader, so it'll be interesting to see how Stan and I might look at some of these things from a different perspective. But that's not to say that I ignore the data as it comes in, right? So I have a thesis, and I buy this company because I think they're onto a big discovery, or I think they're going to build a great mine, or they're a profitable miner and it looks like they're going to double their output or something like that. Some value add is my reason for being here. And if I buy it, I believe it, and I'm bullish on the underlying commodity, well, then I buy it and I wait until that they either fail, right? They don't make the discovery, they don't build the mine, or it doesn't make money, or they fail or they succeed, and then it becomes time to cash in or look at it as a new speculation at that point. So there's no cycle there. There's no timing there. Has the unanswered question been answered, and how? And then you either drop the axe mercilessly, or you sing all the way to the bank with your cash out check, right? So, but on the way, if something happens, like let's say it's a copper play that I was excited about, but now I think that we're going to go into a recession, and that always is bad for copper. Well, maybe I want to reconsider my positioning, or maybe I don't want to buy more, or maybe I want to lighten up on the copper in my portfolio ahead of that and look to buy in again at lower prices, because I could get it at 50% off sale. Like, why put more money into this now if the odds favor a 50% off sale in the months ahead? So I will look at those sorts of things. So it's not just this broad cyclical, commodity super cycle model. I like to be like the weatherman who actually sticks his head out the window and says, yeah, it is actually raining, and adjust accordingly.
Yeah, and so you touched on a lot of great topics there, and there's things from macro analysis, things from fundamental analysis, things from value investing, speculating, and then you do pay attention to some technicals. I know that you're not a technical chartist or anything like that, but things that are broadly trending, I think that you pay attention to at least those things in a broad sense. So what I want to ask is, what different styles do you think kind of go into speculating? Is it macro? Is it fundamental? Is it something else that we're missing?
Well, if I was short term, and frankly, I don't know how to do that. Like, my brand of speculation, as I said, is some thesis. There's a compelling value proposition that I buy into, and I wait till I'm either right or I'm wrong. To do what Stan does, I have no idea how to do that. If I did, I could imagine being a lot more inclined towards TA. And I know technical analysts that they don't even care what the thing is, the stock or the commodity or whatever. They see a certain pattern on the chart, and that's a buy signal, and they buy that signal. Right? And they're completely agnostic to what the asset is. They don't even look at the fundamentals. If it was oil and ahead of a recession, it wouldn't matter. If they saw that pattern to buy or sell, they would execute. That's not me. That's not what I do at all. And I've met people who've made money doing that, but I've never been able to figure it out. So, different strokes for different folks. As far as, styles of speculation, I think most of the people I know in the resource sector are like me in that they have this fundamental, value proposition approach. That within the larger context of, are we bullish on this commodity or not? Where are we at in the super cycle? In terms of, more details of executing, there are some interesting things. Like, most of the preceding generation, my mentors, Doug Casey, Rick Rule, others like that, they teach a strategy of, this is very high risk. You have to understand that you're going to lose on more of your speculations that you're going to make money on but the 10 baggers will more than make up for the losses, or they will amortize the losses, as Rick likes to say, right? So you buy 10 stocks, it's rare that anything goes to zero, right? You'll lose 50% or 70% on a really bad pick. Most of them will just kind of muddle along, plus or minus 10, 20, 30%, get, maybe a double or two. And then that one 10 bagger, it works out so that your average is something much better than money in a bank, right? My average during my Casey research period, and I can't back up this track record. It was based on the yearly report cards published within Casey Research. The average was 18.5% per year for almost 15 years. So that's better than a CD in a bank. If you could compound that, it would be a lot of money. My current average is better than that. But so what I'm saying is, like, there's this idea of, like, look, you got to understand this is speculation. It's high risk. You're going to lose a lot of money on a lot of these stocks. That's okay. The big ones are going to make it all worthwhile. Well, I have found that actually doesn't work for a lot of people. Like, even if it's true, few people have the intestinal fortitude to just take loss after loss after loss. And particularly if the markets fluctuate down, it's not like you have your 10 bagger and some, losers over here or something. What you have is a portfolio that's entirely in the red by double digits. And that is really difficult for the average person to hold on to, or to have, faith. Again, Linus in the pumpkin patch. It's really hard for people to follow that program through. And that's what people make mistakes. They'll sell something at the very time they should have been averaging down. Like, if the thesis hasn't changed, but the thing's on sale 50%, you got to have a come to Jesus moment and say, do I believe in this or not? If I do, it's literally twice as good at this valuation now. And the right thing to do is to average down. So people will end up buying high and selling low if they don't have the strength to see that strategy through. So I have actually modified that, and I'm not swinging for the bleachers as much as my mentors did. I'm happy to get a 10 bagger if I get one, but I'm not consciously trying to bring a bunch of 10 baggers into my portfolio, because that brings a lot more risk. My goal is to actually win on most of my speculations. I know I'm not going to win on all of them, but I want to win on more than half of them. Like, I want to pick winners. And that means fewer 10 baggers. I get that. I'm not swinging for the bleachers on those, extraordinary things. But that doesn't mean I'm shooting for 5% or beating the bond market, right? I'm still looking for extraordinary gains. And, the current average, I just took some losses exiting some positions in Mexico because of political risk, but I think the current average of my closed trades is around 40%. That's all closed trades, not a yearly average or hypothetical average. That's actual results. There's a free track record link on our webpage. So what I'm saying is, I've modified. There's a different strategy here. I'm consciously not swinging for 10 baggers. I'm looking for areas where I can much more reliably get a double, triple, or maybe a 5 bagger. And the result of that is that I don't actually have the number off the top of my head, but I have made money on more than half of my trades, which is very different from what I was taught. And maybe a takeaway here is that, a lot of people have this idea that speculators are gamblers. These wild gamblers are just throwing darts at the board. Woohoo, we made a bunch of money. That is not at all how I defined it. The speculator, remember, you think, you see these trends, and you try to position yourself with that big money basket where the fan is going to blow that money. That's not throwing darts at the board. It can be wrong, right? Your analysis can be flawed. You can be wrong, but it's not gambling. Gambling is a game of chance, right? You're literally throwing the dice or the roulette ball or whatever it is. It is a game of chance. It's supposed to be anyway, if the house isn't cheating. I'm trying to do everything I can to stack the odds in my favor. That's what due diligence does. So I think that's really, if there's one stylistic thing to really focus on, is if you're a gambler, if you're going to, buy something because somebody named Rory Kitty tweeted about it over a beer, don't call that speculation. That's gambling. Your basis for investing is not analysis. It's not research. It's not due diligence. It's, as Rick Will says, got a hunch, bet a bunch. That's gambling. And I would say that's the number one distinction that people should keep in mind. And the takeaway, sorry, I don't mean to go on forever, but the takeaway from this is gambling is much easier, right? You're throwing darts to the board. Yeah, we're having a beer. We're all good, due diligence takes effort. I fly all around the world, and I literally go underground to look at the vein to see if it's really there, right? That sort of thing. I spend a lot of money and time and effort on this. I have a staff. I got a bunch of people to help me out, and we put a lot of work into trying to rationally, with discipline, stack the odds in our favor.
Yeah, absolutely. There is so much effort that goes into that. And Stan, go ahead, please.
Yeah, Stan wants to say something. Go ahead.
Oh yeah, no worries, Lobo. I was just gonna ask you. You mentioned that nowadays you're not looking for the 10x opportunity all the time, or trying to stack all these in your portfolio, right? Have you always been that way? Have you always just looked for, I'm making smart choices, I'm making the right decisions, this has somewhat reached my goal, I left, maybe a little bit, it's even higher now, great, I'm happy with it, I'm done? Or has your process evolved over time and you have adapted to the markets, you have adapted to social change? Because the way I understand it and what I'm getting from you is, you have a very much 30,000 foot view of a big picture idea, of a big thesis. Here's point A, some magic needs to happen, but I want to get to point B. I'm not worried about the magic as long as we don't retrace beyond point A, sort of thing, right? So has that changed over time, or were you more aggressive in the beginning and then slowly tighten up?
People say, "Oh, great question," while they're stalling for time to think of the answer. But that really is a great question. Nobody has ever asked me that before, and I think it's actually important. There is a takeaway here. The answer is yes and no. There's certainly been evolution over time. I think it is my character. I don't, I'm not a wild and crazy guy with taking lots of risks. I think by nature, which is not to say I completely lack spontaneity, like the bad guy in the movie, the boring husband in the movie, right? But I think by nature, I have wanted to know, I have wanted to understand, I have wanted to test that the rock under my foot will bear my weight before I shift it on there. As a climber, that's what they taught me. And then I think it was within a month of working for Doug Casey that he asked me to research something, and I presented my findings to him, and he looked at me and said, that's really smart, but we're going to do this. And he was right. And the thing went crazy, right? I don't remember what the investment was, but I remember him telling me, that's really smart, but this is what we're going to do. And so I think, working in that environment, I took on a lot more risks. I think also early on, I didn't have skin in the game. I was dirt poor when Doug took me under his wing. And so I'm writing about the stuff, I'm helping do this research, but I wasn't investing myself. So it was theoretical to me. And, if something, I hate to say this because it wasn't like I didn't care. I thought I cared. I thought, I was doing my very best. And I'm, at the time I was. But now, my portfolio is not a model portfolio. It's my actual portfolio. It's not that I disclose that I may have a conflict of interest here, or I might invest in some of these things I write about. It's a portfolio of only things that I'm willing to put my own money into. So I have 100% skin in the game. And I can tell you that the emotional balance when you're doing the due diligence and you're going to write your own check to put in there, it's pretty stringent, the criteria there. I hate losing money. If anything, I have combined Doug Casey and Warren Buffett. Warren Buffett says don't lose money is the number one rule. Doug is like, you've got to swing for the bleachers. You've got to shoot for extraordinary gains, or you're only going to get at best ordinary gains. Or here's a Doug Casey strategism to take away. And maybe this will be of interest to you, Stan, and the broader audience out there. He says, why risk 100% of your capital for 10% gains or returns when you can risk 10% of your capital for 100% gains. So even Doug doesn't say like gamble wildly and throw money at everything. He's saying have a portion of your portfolio that you can afford to risk and dedicate that to extraordinary gains. And guess what? If you lose, it's not like you're going to go hungry, you're going to lose the house. But if that smaller part of your portfolio that you dedicate to disciplined, rational speculation, has the potential to blow the rest of your performance away, why not do that? So the answer is a bit of a cycle. I think by nature, I was pretty cautious. Hanging out with people like Doug Casey, maybe a little bit, more willing to embrace more risk than I might have otherwise done. But then over the years, just, the people who, they're not multimillionaires like Doug Casey, they can't laugh off the losses, or they don't have the intestinal fortitude to average down, aggressively when a great story is on sale for the wrong reasons, and they end up buying high and selling low. The amount of pain that I have, I've seen the emails like people wrote, that has deeply affected me. And oh, by the way, hubris. In 2009, Doug and others that I respected, we were all sure that there was no way the powers that be could land that ship, right? The great financial crisis, that was it. The financial house of cards was coming down, right? The global financial system was going to implode, and it didn't happen. Somehow, they kicked the can down the road again. We were wrong. So that's made me very cautious about this 30,000 foot view that you're talking about. I have that, but I don't want to have the hubris to think, I'm necessarily right. So I mitigate against that risk. And you, as a speculator who's trying to position yourself ahead of where the money is going to come, you have to have that theory. You have to have that projection. But you also have to be the weatherman who sticks his head out the window and says, yeah, it actually is raining, and adjust if it wasn't supposed to rain. Or else you're going to wipe a lot of people out, and yourself too, if you're putting your money where your keyboard is. So that's the evolution, like, more risk. And then now, with what I've learned, I'm trying to balance it more. I won't say I take no risks, but I'm much more cautious about it. And I will literally not, I'm not throwing Doug under the bus here. I mean, it's a different style. But one of the things he would say is, that's worth a punt. Right? We'll try it. I never say that. I will literally not buy a stock if I don't think I have at least a 50-50 chance of winning, 51-49. But I just won't do it. And that is different.
Mm-hmm. Yeah. No. And I think that I think portfolio sizing is a big kind of topic based around that, because like you're saying, someone who is immensely wealthy, whether it's Doug Casey or someone who has, had a very successful career, and they're taking, shots at a lot of things that have potentially high reward. I think that people have to understand that the sizing that he's using as a percentage of a portfolio is not
the spread of his shotgun. Sorry.
Exactly.
Right? Yeah.
Yes. As opposed to someone who has $100,000 and they're like, I'm going to put in 30% of my portfolio or 50% into this opportunity that someone else is putting 0.1% in or 1% in. And so I think people need to have a very clear picture of the risks with that. And, portfolio sizing or position sizing, that's also a very applicable thing to, whether it's day trading or traditional trading too, because like Stan and myself and others who trade like that, you can have a strong thesis. You can be looking at the volume, the price action levels, who's offsides and things like that. But you always have to be positioned so that even if something goes wrong, even if it all goes wrong, you can still walk away from that. So do you have kind of a fixed position sizing, or is it like depending on how good the opportunity is up to a max of 5% or 10% or 20%?
I would say that the downside protection is not letting myself, hubris again, not convincing myself that I'm so smart, I've got it all figured out, that I'm going to, get a second mortgage and go all in on my favorite investment thesis. My mitigation is mostly in that, my net worth may be more in real estate than in mining stocks, right? Or, my larger financial universe. Again, Doug's thing, you don't put 100% of your portfolio into crappy little mining stocks. But you put that high stakes end of your portfolio into it. But within that, I don't have that. The answer to this actually is that a great speculation, like one that really ticks all the boxes. You got a great jurisdiction, the indications of the discovery are there. It's got predictability, it's happening, like this thing's got momentum. You're bullish on the commodity, the jurisdiction is safe, the management, they've done the same thing before, right? You've been there and it's true. You've proofed the story. If everything is there, you don't want to have a Procrustean view like, oh, well, but I've already got enough of this in my portfolio, so too bad, right? A great speculation is so rare. Like it really is rare. I have a monthly newsletter, and there are many months where there's no new stock pick. And that's a good thing. Like if there's a new, this is the cat's meow, the best speculation ever every month or week or whatever your publication is, it can't be true. Like you cannot have the best idea of the year every month. It is that you literally can't do that. So every once in a while, a new client will say, "Well, gee, there's no new pick here." I'm like, yeah, that's good. That means I'm not just recommending any shit because I've got a deadline. Sorry, that was a technical description. Right? There wasn't anything that cut the mustard this month. So when that gives people confidence that when I do find something that makes the grade, then I really believe it. And of course, I put my own money where my mouth is. So where I'm going with this is, if something is a really great speculation, I want to be able to allocate to it. And I'm instead of setting a portfolio limits, I will go with it because it's a great speculation, even if I'm a little overweight on that. But the more overweight I am on that, then the more I start thinking, well, I need to take some profits here. I need to start looking for more opportunities in the other place. So instead of saying no, or instead of putting a hard stop to how much I will or I won't do, the more I have a sense of, well, like gold this year versus uranium last year, or I'm overweight, uranium, or I'm overweight silver or whatever. Then I just start looking for opportunities in new directions. And that's how I manage it, because I always want to be able to say yes to a great opportunity. And by the way, this is why I basically never go all in. I have never gone all in my portfolio ever. I've gotten down where I've only got less than 5% cash. And that makes me very nervous, because if a once in a lifetime opportunity came up, and you might say, well, gee, you've got time, you could have a garage sale or something, sell some blood. Yeah, well, if it's a private placement though, and you could literally have just that day where it fills up and then you're done. Like it's full. The allocation is done. You're not getting any. So if my portfolio ever gets down to so little cash that I would worry about missing out on a once in a lifetime opportunity, then I will have a garage sale or sell some blood or do whatever I have to do, right, to send more cash there. On the subject of cash, I don't think I've ever had more than 50% in cash. If I did, I would feel like I was, asleep at the switch here. The idea of that money is it's supposed to be working for me, and I should, I shouldn't all be there. I mean, so we'll see. It's somewhere in between, depending on market conditions, depending on opportunities. But really, the main takeaway here is a really great opportunity, one that ticks all the boxes, and you believe in, you understand it well enough to stand by it if it fluctuates or whatever. That is a rare and precious thing, and I want to be able to be liquid enough to take advantage of one, no matter what.
Yeah, and I feel like so often when people think of an incredible opportunity, they're just looking at how much upside it could potentially have, but that's not a well-rounded exceptional opportunity. It's how much upside does it have? What's the probability of it happening? What's the downside if you lose? And you really have to look at the entire picture. And then going over to Stan, kind of the same question about position sizing. Do you have hard and fixed rules, or is it within a band of reasonability, but you also want to be able to size up more on an opportunity that's very big, because you do have a large discretionary part of your trading, right?
Right. Yeah, that's right, Chris. And as you know, and Lobo, for a little background for you as well, the way I trade is I like to scale into positions. I like to start in a little bit, get a feel, a feel of how the stock is behaving, how the buyers are, the sellers are, etc. For me, the emotional aspect, the psychological aspect of trading is really important. It's understanding how am I feeling on this side of the trade, simultaneously of how somebody else is feeling on the other side of the trade. And if something happens, right, if my risk exposure is one where if it goes against me and I am wrong, it would be devastating, then to me, that signals a much less sized position. Because sure, I can be right, that's great, we'll make the profit. But if the alternative outcome, if I'm wrong, it becomes devastating, then that's a stock, for instance, that I'm going to trade very small size, right? You have some of these, China liquidation names or whatever, just low flow, piece of garbage companies where they could skip into a halt and then resume 100, 200% higher. It doesn't matter what kind of risk control you have at that point, your hands are tied. You can't do anything when you're in a halt and then it just resumes, 200% higher. So the only way to limit that risk is by, your exposure into the market versus size. So for me, sizing in and sizing out is what works best because of that, aspect of the psychological approach, the emotional approach, the not just the technical and fundamental analysis, but everything else that goes along with it in the mindset and other aspects. So sizing in, sizing out of trades, and ultimately my risk is not say, I'm giving it 10% or I'm giving it 30% or whatever the case is. One of my cardinal rules is I must have an exit before I'm even in the position. If I don't know where I'm out, I don't have a trade, right? And being out meaning whether it's the risk aspect when I'm wrong or whatever some of my targets are. But having an exit defined first is one of my rules. And, not being able to execute an entry because it doesn't meet a criteria, that's perfectly fine for me. And ultimately, I like to scale into my winners, and then I look at the probability aspect of a trade. So something that has 95%, say, historical and studied and due diligence probability of succeeding, even if it only runs for, say, a small range, I would be much more comfortable sizing into that trade because I know the outcome and, I know its probability versus for me to enter a trade when it's 50-50 with less size and kind of, look at it that way. That doesn't work. Right.
Yeah, absolutely. And
Makes
Lobo,
sense. Sorry, let me just jump in with something else because something Stan said made me think of the opposite side of this, and that is just the basket approach is obviously really important, especially as a speculator. You really can't fall in love with any one company. You can't, even that 10% or whatever that you're high risk, you can't put it all in one place. You eggs in a basket, the logic there, but you also can't spread yourself too thin. If you just buy everything because it sounds good, or you saw a CEO interview or something, it sounded good, whatever, you just start buying all this stuff, you're spreading yourself too thin, but B, you can't follow that many stories. And you'll find yourself making poorly informed decisions. Something will sound bad that actually is an opportunity for the company, and you'll sell because it sounds bad. You don't even remember the name of the project or what country they're exploring or something. You thought they were in Ecuador, but it was El Salvador or something, and there was bad news about El Salvador, and you sold. Well, it turned out, you made a mistake. So the way I look at it is you should have a basket, and you should have enough money in any position that if it succeeds, it matters to you, right? If you put, $100 into something, you get a 10 bagger. Well, yeah, $1,000, that's nice. But for most of us, that's not going to change our life. If I put, $1,000 into something and I get a 10 bagger, well, 10 grand is nice, but it's not going to change my life. If I put 10 grand in and I get a 10 bagger. Well, now we're talking money here. Now I could do something with $100,000. So depending on your scope there, you want to have a basket of stocks that or investments that each one of them is material enough that if you're successful, it matters to you, the outcome. But you're not spread so thin that you don't even know what's going on. You can't remember why you bought this one. This happens to me a lot. I'm at a conference, somebody will come up with like this printout that's a yard long. I have all these stocks. What do you think about this? Well, why did you buy that? Well, I don't know. So I think that may be, a key part of portfolio management is just don't get too excited about any one. Don't spread yourself too thin. Be realistic about how much time you have to put into this, and have a portfolio that you can manage of positions that will materially affect you if you're successful.
Yes. So kind of like the golden standard, or I guess what everyone is kind of looking for, and both on the speculation side and on the trading side, is to be as concentrated in high quality opportunities as you can be safely. And so, you want to really focus in and concentrate, but you don't want to be so convicted or so concentrated that even if something is a great reward, even if it's great opportunity and probability, if it goes wrong, because nothing, the market doesn't have to do anything. If something goes wrong, you can't be so positioned that it takes you out if, the smallest thing goes wrong and it falls apart. But Lobo, earlier on, you mentioned GameStop. I forget if it was on camera or off camera, but I want to get your thoughts on a couple of current events of just, what are you paying attention to in this market? Is anything, exciting? And obviously not into detail. People can go to your newsletter at The Independent Speculator for that. And I've subscribed to your macro report for many years, and it's phenomenal. So I invite people to check that out as well. But what do you make of the current market?
So I guess broad strokes are all these people who are saying that if we haven't had a recession by now, we're not going to have one. I think that's historically ignorant. We're just now getting into the average length of the, famously log and variable lags between policy tightening and a recession in the US specifically. I do think that we're still going to go through the ringer here. Or if we don't go through, it'll be because the money helicopters fly again. And I think they fly one way or the other, whether we go all the way through or not. That's broadly speaking my outlook. I think it's inflationary. I think it's good for commodities. I am not looking to buy industrial minerals ahead of that bad news, but the right ones once the damage is done, I certainly am. So right now, that macro context has me focused on gold, silver, and uranium, because uranium doesn't care about the recession, and almost literally nothing else until after I'm either wrong about the recession or it hits and I have those buying opportunities that I'm looking for. Broader than outside of my wheelhouse, it's not my expertise, but I think people do, for that other part of your portfolio that's not in rocks, right? What else are you going to do? I can't tell you which is going to be the next NVIDIA, right, or the next big AI play. But this AI thing, it's not just hype. It's not just a fad or something like that. This is a big deal. This really is like the advent of the internet itself. There will be huge money to be made here. This is not just imminent. This is a happening now thing. There are whole swaths of jobs that literally no longer exist, that existed a year or two ago. Like those people typing in the real estate descriptions and stuff like that. The AIs are doing that. This is happening right now. Exactly how to play that, how to win. Well, in my wheelhouse, I see it as a tailwind for copper and some of the minerals that are necessary for this. Like, is it reasonable to pile into NVIDIA now? I don't know. That's a really incredible valuation. But if I had shorted it on that basis a year ago, then I'd be eating my shorts, right? It would be really bad. So I literally do not know how that will go, but I know that this is a field, kind of like we mentioned biotech before. If you knew about that, there'll be great opportunities there. If you knew about this, there'll be great opportunities there. In my case, I'm willing to kind of sit back and wait to see how these trends shape up. Like, who's going to be the Amazon of AI, right? Maybe it'll be Amazon. Maybe it'll be Apple. We actually don't know yet. It might be that somebody has, AMD or Intel, they have an NVIDIA killer chip that they're going to announce tomorrow. Like, that could literally happen. And I don't know which way that is, but I do know that once that chip is announced, there'll be money to be made on it. Or once it becomes clear that Amazon, the Amazon of whatever, that really is an Amazon, there'll be money to be made on that. And your audience is broader than mine, but to the degree that my audience has come here to watch this show, and they're so focused on the rocks and the metals and the minerals, I actually do think it's important to pay attention to what's going on in the larger world there, because there's money to be made, but B, if you don't, you can be blindsided. Your other businesses or those of your children or grandchildren, if you're retired, could be profoundly affected by something that is truly on the scale of an industrial revolution that is happening right now. There's that Chinese curse, may you live in interesting times. My Chinese friends say that that's actually only half the curse. It's may you live in interesting times and come to the attention of important people. That's if you really hate someone, you want them to come to the attention of important people. So we live in interesting times. We don't got a choice about that. I hope you don't come to the attention of important people, but I hope you do pay attention to what's going on, because there is both, risk and opportunity in a truly historic moment. And I'm glad I made Stan laugh.
That's good. Yeah. I don't know why that one just, I think I internalized it a little bit, and it was
That
good.
is very funny.
Yeah.
And one of the things I wanted to make a little bit of the case for where trading might kind of fit into this, because as you're saying, there's many of these trends that are in place. Excuse me. For multi months or multi years, they can be real things, but the issue can be there's not always an ideal entry point for a longer term kind of thesis on something. But with trading, there is a way to capitalize on those things if someone is trained and skilled in trading, and if they're able to do that in a professional manner, not just I'm going to buy this and sell this really quickly. That's not trading. Just like speculating is an art and a science, and investing is, so is trading. But for instance, like we have been watching Nvidia and many of these names trend very well for the past year and a half, and there are pockets when it's extremely bullish and we can ride that up for short periods of time. And there are pockets where, it reverses and it flushes down, and we can also ride those periods as well. And then a lot of times over the course of a couple of hours or a day, or even, if we're swinging it for a couple of days or a week, much shorter time frames, we can be back to cash after those moves happen. And so we don't have to have necessarily a thesis about the next year on something, but if we can, if our eyes are trained for what we're looking for, and if we can capitalize on those, then I think that that's part of the reason why I want to have this conversation, because I think that there's a place in a portfolio, and if someone is inclined to learn these different styles, to blend them, and I think that can be very valuable.
Let me maybe throw this to Stan here, because I don't have experience on this, but I have been working on this, or I've observed this, and I haven't been able to define it well enough to do any math on it. And that makes me, as an analytical type, hesitant, right? So I'm watching this NVIDIA thing, and I completely missed the boat, right? I didn't buy any phase of that. I didn't make any money on that at all. Because every step of the way, as a value speculator, and I know it sounds like a contradiction, but I am looking for a value proposition. And I just don't see it, right? I don't see... Or rather, the value proposition strikes me as more like gambling than speculation. It's, well, if A, B, and C happens, then NVIDIA will be worth 10 times more. But there's no way to know if any of those things are going to happen. Or this, NVIDIA killer chip comes out, right? The whole thing could be off. There's so many huge unknowns there that would completely blindside me that I feel paralyzed. But there's, I think, a more useful takeaway in this, and this is where maybe Stan can help. I have seen over the years that we call things a flavor of the day. Like maybe NVIDIA was a flavor of the day, maybe GameStop was a flavor of the day, or lithium recently was, flavor of the day. Maybe uranium last year was flavor of the day. We call it the flavor of the day, but it's never a day. And this is really important. Like people think, oh, flavor of the day, oh, that was interesting, but it's flavor of the day. It'll blow over. I don't have math on this, because exactly how you define something that can later be seen as a flavor of the day is very difficult to standardize in such a way that we can do this. But my sense is that flavors of the day often last a year or more. Like NVIDIA, how long has that been? GameStop was shorter. Uranium last year, if that was a flavor of the day, that was not quite a whole year. There are all I'm saying is if you found a way, and maybe as a trader, Stan could help somebody operationalize this, but if you found a way to say, this is a flavor of the day thing, like we've hit this moment, this has all the right media frenzy, this has that kind of feel that this is going to be a flavor of the day, then maybe a trader could help you operationalize that. And how do I invest in this space? Because for me, I can see something looks like a flavor of the day, but then as a value speculator, I look at the company's balance sheet, I look at the cash flow, I look at the PE, and I'm like, there's no way I'm buying this. And I end up watching the flavor of the day take off from me. So Stan, maybe you can help me out here, or Chris, I'm not sure what to do with this. But the main point is flavor of the days are longer than the day. And if you can figure that out, there ought to be a way to make money on that.
Yeah, and I mean, Lobo, I think that translates to the trading world very well as well in terms of flavors of the day, and we have them as well, and they truly stand to being flavors of the day, right? You have a one day wonder opportunity that some stock was, say, whatever, 30 cents, and today is $1.50, and that was it. By the end of next week, it's going to be back down to 30 cents, right? So truly is that flavor of the day. And then in terms of your question, right, how do we determine, is this just that hype 1 year that this is going to be the next best thing, or is this just are we just creating the launch pad for the next leg, essentially? And I think
or how do you know you're not the bag holder who's going to buy the top of the hype?
Yeah, exactly.
Maybe that's the short version of the question.
Right. And I think honestly, Lobo, I don't think there's a truly way anyone can know with 100% certainty, right? I mean, markets in general are just a probability game. It's just a function of one. But for me, as being a trader, there are some moments, some well-defined rules when it comes to either risk management, in order for that to protect me, to not be that bag holder that just bought the highs and now I'm stuck for the next 18 months, or there will be a point where a certain technical move will for me say signal, okay, this maybe resets the chart, right? And just a quick example, say you have NVIDIA that gaps up and it goes and it runs 2-3 days, every day gapping up, and then for 2-3 days we consolidate sideways, and then it gaps up again. Now, from a technical perspective, I don't mind trading that next secondary leg because the risk is so small, right? My risk would be below the most recent consolidation, and then I can take advantage of the next leg. And from there, you could view and maybe build a position for the long term. Now, I chuckled earlier because, in the very beginning, you mentioned, you're like, there's traders where they trade these companies and they don't even know what they're called. And I think that's probably me, right? There's a lot of times where I don't care what the company is called, what they do, what any of that stuff is, right? I have my process to where I'm able to quickly pull up the financial aspect of it and look at their balance sheets, look at their cash flow, etc. Their dilution, but everything else, it's more so based on the opportunities. And for me, that flavor of the day, like you mentioned, where it lasts about a year, that is such a long term for me as a trader, right? A year, everything happens within a year for me. So I think an advice to come from me where, someone's right, 1 year is such a long-term view for you, to where you're trying to get and build that position to go to the next level. There's just such a big discrepancy in the overall view of the move that, like I said in the beginning, I don't think we truly know for sure. I think at times we just have to do our best and rely on your experience and our statistical knowledge to say, this is it. This is where I'm risking, and I'm not going to be a bag holder. Or if it breaks above this level, I'm getting in because I know where I'm out, and I'm just closing my eyes. There's been times where I'd have to do that because, and it's not in a way I'm closing my eyes, oh my God, leaving my screen. It's more so everything emotionally is telling me this is too high, but there's just so much factual evidence on the chart that this is going higher. And that's the moment where I need to step out of the way and let the chart work, because it's me, it's my mind that's getting on the way. It's those emotions of, this just went from $20 to 200. How high can it go? Well, the stock that goes 500%, it doubled first, then it tripled, then it quadrupled, and so on and so forth. So the best 400% winners are the ones that double first. And if I take myself out of that opportunity when it doubles and say it's too high, I'm not touching it, then you miss the true move, right? The true meat of the expected value.
And I would add to this because Lobo, what you're describing with the flavor of the day, and then what Stan was just describing. So I have a background in both the styles, and I've used this before for exactly your question. And Charlie Munger had a great term that he called the Lollapalooza effect. And it's basically when you have a bunch of things all working together in the same direction. And he would use that in order to predict kind of not necessarily flavor of the days, but when something didn't make sense to him, he would look at many different variables all moving in the same direction. And I bring that up with something like NVIDIA or with the AI trend, where you have many different variables. You have a fundamental variable, you have a technological variable, you have news headlines, you have a new cycle coming back after a bear market. And so you have all these things moving in the same direction. And so what I try to do when I'm playing these long-term speculations or these flavor of the days using a combination of trading, speculating, and holding, is I will try to identify every key variable that I can. And it might be 5 or 6 or 7 of them. And then I just try to keep tabs on each of those. And as they fall off, that is what kind of tells me that the cycle might be coming to an end. Whereas with NVIDIA, you might have things like, okay, well, maybe the reflation cycle from the bear market we got out of, maybe that's one of the factors that's starting to stall. Maybe the news headlines don't, hit the same way that they used to, and they don't really move on that, but it still has the fundamental aspect. And so it's kind of hanging on. But if something were to come out where now the fundamental aspect of NVIDIA changes, where someone does invent another chip or something like that, then that could be like the last thing holding this thesis together, and that can be the linchpin that drops it. And so I've used exactly what you're talking about for my own trading. And so I use an approach where I use a confluence of factors all going in the same direction. I try to identify them. And then when they start to fall apart, I have to be able to be objective about that. And that can be a signal for a longer term trend change.
It's interesting. Lollapalooza effect. I'll have to remember that. It makes me think, actually, as much as I have my favorites and things like that, the closest to this in my wheelhouse would actually be uranium right now, which is in correction. But all of those factors that you're talking about, it's striking to me to see CNBC and places like that, Yahoo Finance, where all they seemed to talk about was Chipotle and NVIDIA or whatever, right? To see these places talking about uranium, and of course it fits in now to the green agenda. So you've got, and then now the AI thing is another demand for power, and so you've got like all these ducks in a row. Plus the fundamentals are there, the supply and demand. The supply is just not there, and then you have the price breakouts, you got the technicals, you've got this fundamental story, and now you've got the media sort of starting to pay attention to this. And I would say that last year was not a flavor of the day. Last year was a breakout. If it continues, sorry to hijack the conversation, but it just fits into what you were saying. I could see this being like that, where all these confluence of things come together. If the environmental panic, the people who think we're all going to die in 11 years, if we don't stop oil now, and the people sympathetic to that view, they are starting to see nuclear as necessary, maybe a necessary evil, but necessary. And this is huge because it uranium was like the most hated of the 92 naturally occurring elements in the world, now it's carbon. And it's much more hated than uranium. And that game changer has investment implications. And if it becomes a Lollapalooza trend here, I think what we saw last year is just the opening salvo.
Yeah, I totally agree with that. And so we're running short on time. So there's one other section I want to get to, just a couple of quick answer questions. But before that, I want to announce the t-shirt winner from last episode, and that is Andrew D8954. You can email webmaster@investorsunderground.com to get a Trading Takes t-shirt. And then Lobo, the last couple questions I wanted to ask just real quick are, what's been the most enjoyable part about, running your own business for these last couple of years? I'm sure that there's ups and downs, but what's been really fun about it?
Boy, it's funny. When I worked for Doug, and I was giving a seminar about entrepreneurship, and one of the students said, "Well, how come you don't run your own business?" It's kind of an embarrassing moment, and so I've done it before. So no, I like being my own boss. I like working whenever the work needs to be done instead of having to go to an office, all that stuff. I work much harder as a business owner than I ever did as an employee, because the business never goes to sleep, right? There's never a moment of most needs. But maybe fun isn't the right word, but I feel an enormous sense of pride in creating something that didn't exist before. And this audience, if they don't know me, they don't know this, but anybody who reads the free letter I get, they know that it's true that I don't spam them. You get one email per week and that's it, right? And so I hate all this hype and marketing and all this stuff that's so common in my business. So I feel I'm doing well. The business is growing. I have a lot of help now. I have minions. I have a brilliant group of analysts and other support people that enable us to cover hundreds of companies that I wouldn't be able to do on my own. And this didn't exist before. And the quality of the work, we get things wrong, but we're not for sale. No company, there's no amount any company can pay us to give them a thumbs up when they deserve a thumbs down. And the clients know that, and they trust us. And I get this every day in email messages. People are grateful for the work that I do. I don't have to trick people into subscribing or something like that. People want to give me money because they want the knowledge and the expertise, the due diligence that I can give them. And that's, who needs a drug when you can get high on something like that? My father is proud of me. And he's, I'm the black sheep of the family. So I don't know how much that means to you, but to me, that's an amazing thing. So yeah, I'm very happy to be a reasonably successful entrepreneur.
Oh, that's great. Thank you for sharing, Lobo. I just had a quick question. Given that, as you mentioned, you like to be in the trenches, right, behind some of your investments and go and check them on site. Have you been in any, sketchy situations? Anything, was there anything that stands out that you're, legally allowed to share or willing to share, or
well, like physical safety or investment safety? Like I've gone to mines where, they're like, oh, you got to see this. It's amazing. You go there and there are a lot of girls and alcohol and no rocks. I'm not going to name names. I remember one time there was one like this where the guy say, I'm there and there's this office. There's 30 people in this office and one guy, the CEO. They're all women. I'm sure they were all highly qualified to be there. And I'm like, well, I came here to look at the mine. We haven't, and it's like, well, you can see it better on these diagrams. So I could see that in Vancouver, right? And so he said, well, take a geologist in a helicopter and go look at it then. And I think he didn't think I would do it. So I said, okay, and I did. And I got to the mine. We landed the helicopter on the edge, and I got my rock hammer. I had my own, and my boots, and I'm ready to hike. And I know you can't go in there. Like, what do you mean I can't go in there? It's what I came here to do. I want to sample. Well, it's dangerous. Okay, got back in the helicopter and flew back to the girls. I didn't touch them. My wife could watch this. So, it's things like that happen. accidents happen. I've been underground once where there was an accidental detonation. That was interesting. I won't name the company. It really was an accident. But, accidents kill people in mining. So maybe the most fun one, we got to run it. But I was an early stage exploration project. We climbed up in the mountains. It was way up in the mountains of Colombia, like vertical climbing the jungle. And we got up to look at the rocks, and some illegal miners had already moved in and started operating on the exposure at surface. They had built a water-powered ball mill with fire hoses and rocks in a creek, and they built a wooden turbine out of an old barrel or something. It was amazing how much they had done. But we got there, and it was like the dwarves were at the mine. There was nobody in this camp. And we're kind of poking around and looking at this. And then suddenly the dwarves start filing home across the mountain. And we figured they could run faster than we did. So we just sat put. And this is Colombia, they all had these huge machetes. And, I wasn't sure what was going to happen there. But the geologist was really cool. He's like, look, we're with the company. We have the underlying mineral rights. We don't care what you're doing here. Actually, it's kind of like sampling. We're fine with this. It doesn't affect us. I can't promise you there'll be any jobs if we make a big discovery or anything, but we're just looking and we're not worried about you guys. And it turned out exactly the right thing to say, because one of the guys had been fired from another company that did the opposite, like promised everybody jobs, and then the markets went south or whatever, and so he was bitter about this other company that made all these promises. So it just worked out, and they brought out what is the Colombian version of pulque? I don't know. It was some kind of alcohol they made there in a tent, and they were sharing it. It wasn't very polite to say no, but it turned into an interesting evening.
Yeah.
And that's survived.
Great. That's great.
Unbelievable. Well, Lobo, thank you so much for coming on. I think this has just been a fantastic conversation. I've really enjoyed it. And I was telling Stan beforehand that I think I've followed you for a long time, and you and Stan kind of remind me of each other in the way that you approach, your own disciplines. But it was great to talk with both of you, and I just really appreciate you coming on.
All right. Well, I'll have to check out Stan's work. I'm intrigued, and thank you.
Absolutely. Thank you, Lobo. Yes, it was great speaking with you today. Thank you.
Yes. And then the final thing is, how can people either follow you or learn more about you?
Well, independentspeculator.com. As I said, the best thing is just try the free letter. You may not agree with me about everything, but I promise you won't get spammed. That's one promise I can make.
And as a subscriber to your macro letter, I can say that is absolutely true, and I get a lot of value out of it.
Thank you.
All right. Thanks, guys.
Thank you for tuning in to this latest episode of Trading Takes. Don't forget to hit the like and the subscribe button. And if you enjoyed this conversation, please check out some of others with some great traders. Thank you for watching.